Recession watch. Oh my God. Recession, recession, recession. This doom porn that happens everywhere. So finally, recession watch is on. The official numbers don't say recession yet, but leading indicators might tell a different story. Is the slowdown real or just a scare?
As a
Um,
as a reminder, it feels like more often than not, many of the macro experts out there predict about 20 to 25 of the last 3 recessions. So let's just remember that this comes up quite a bit. If you've heard this story over and over and over again in your trading career, it's easy. It should be easy to take this stuff with a grain of salt. However, what have we discovered so far, Tom?
Yeah, well, just to mention what we were talking about in previous episodes is that a recession is different than a market correction, folks. Okay, the stock market could go down 15%. It doesn't mean a recession has started. It just means
Agreed.
it's a pullback in liquidity or pullback in
And
investor
there's
sentiment
lots
or
of
whatever.
reasons for a pullback, not necessarily a decline in GDP.
Exactly. And so in our Carson corners we've been talking about, he's been calling out these periods of weaknesses that happen around options expiry, and
Hmm.
he made the claim that between February 20th and March 20th, there's an air pocket and we might fall. Hey, that's exactly what happened.
Hmm.
And when we take a look at what's the market position, and we're seeing that now vol is actually getting pretty well supplied. The volatility surface of the indexes has smoothed out, and so the chance for another 10% down, not so high right now without a catalyst. So vol is being supplied there. It doesn't mean that a recession can't happen, but as far as this forward-looking market behavior, that's not what we're seeing right now. It seems to be a liquidity issue. However, it would behoove us to actually take a look at some of the criteria here that we would be watching for if a recession was going to happen, right? So I know everyone always talks about the technical recession, 2 quarters of negative GDP, which I find to be the worst possible definition for a recession. To me, Mike, it's like when people describe inflation as rising prices.
Hmm.
I I want to blow my brain out. I can't believe they keep saying that. Yes, if you look online, because of like colloquially, people have used that again and again. Yes, the dictionary has changed the term for inflation to mean rise in prices, but that's not what inflation is. Inflation is inflating the money supply,
Hmm.
increasing the money supply that's in circulation, which has the effect of causing high prices.
Which reduces
Uh,
your purchasing power automatically,
ex-
right? It's like
exactly.
it's probably easier to think about it by saying what you used to be able to buy for a dollar, you can no longer buy for a dollar, right? It's
That's
not
right.
just about the general increase in prices, but rather the erosion of your purchasing power over time.
Correct. Which is different, let's say, than currency debasement, which is what when the Fed buys bonds or buys public assets or monetizes debt, that has a different effect, which is like asset pricing increases and real estate goes up or whatever. But that's not inflation specifically.
Sure, sure.
Well, similarly, recessions, folks, recessions are contraction periods to the expansion periods of fiscal largesse. That's what it is. It's when the economy is juiced. The economy goes through these ebbs and flows where more and more people enter into the starting new businesses, get new jobs or whatever, and then you have this dynamic between employment and consumer spending that causes this expansionary period that can go on forever. It needs to pull back at some point, and you're going to get a contractionary period exacerbated by how central banks print money or do whatever they're doing or government spending. And so recessions are natural. The thing is, to call 2 quarters of negative GDP uh, a technical recession is like calling a 10% drop in the stock market a bear market.
Sure. I think that's a correct assessment. And I think right now the news is basically more concerned that we're seeing additional GDP contraction, but not necessarily a negative GDP
That's right.
growth. If we can go back to like quarter 1 of 2022 and quarter 2 of 2022, we experienced 2 quarters of negative GDP growth during those periods, but we didn't count that as an actual recession. Since then, we've seen an increase in GDP growth over 22 and 23, but we've seen a contraction in that GDP growth quarter over quarter. All of that said, it's still not in negative territory yet. I think right now the St. Louis Fed is predicting that there will be another contraction in GDP growth, but we're still in positive territory. We're not even in negative territory yet. Additionally, if I were to add to that definition, I would say we would also need to see that negative GDP growth accompanied with a larger increase in unemployment. We've been varying around these unemployment rates of like point, the changes have been 0.1 or maybe
4.3,
zero point 0.3,
4.1,
like very small differences in overall unemployment change. We're still at what, 4.2 right now, or 4.3?
4.1, 4.3, yeah.
4.3. 4.3 or 4.1. The point is, it's still at 4%. We're at basically 96% full employment in America. So I would want to see that coupled with larger layoffs than some of the headline numbers that we're seeing, about, the 80,000 people fired from X company or let go from one company or from another, and so on and so forth. I know there's been some headline news around layoffs, but they're not big enough to make a large enough impact across the entire private sector. We're not seeing enough of that reported to show that unemployment is increasing by, a concerning degree. I think that would be my second stance on
Yeah, I
a
just want to make
recession.
the point here that um, the three other major institutions that declare recessions, their uh, their definitions for recessions are super vague. So, for example, the NBER, the National Bureau of Economic Research, they are looking for a decline in GDP, real income, employment, industrial production, and wholesale and retail sales. The IMF, International Monetary Fund, they're looking for a general decline in economic activity. That's literally what they have in their documentation. General
So it's
decline.
feelings based. That's what I'm hearing.
Feelings of basis, vibes based, exactly. And the OECD, they're looking for a cumulative output gap of for the GDP of more than 2%. So they're looking for like this cumulative effect over time. None of them will have a set, like you can't make an indicator specifically for GDP's happening, and you
Sure.
can only really look at it in retrospect. And so there's actually no point in like sitting around calling the recession. Like it doesn't make any sense because you can only really know it in the rearview mirror. What really matters is the decisions you'll make if a recession, like, so this is always the point I want to make. We know a recession is going to come. Like people act like we can avoid the recession. It's a bad thing that we need to avoid. No, it's gonna come, and you have to then plan accordingly. The grasshopper and the ant idea over here. And so, to that end, I still do look at recessionary indicators to give me some sense of the mile markers of what direction we're actually moving in.
Agreed.
If we take a look at, I thought it might be nice to, hey, I'll pull up Grok. Grok did a great job of this. Deep research. 1 second here.
And no, this is not a paid sponsorship from Elon Musk or
It could
Tesla,
be.
or
If they want to
it could
sponsor us,
be.
I'll take
If they want to
it.
reach out and let us know. Right now, we're filling our ad spot with our own company.
So we already talked about GDP growth rate, which is still positive, if just a little bit slowed. Unemployment rate. Oh, it's at 4.1. You're right, 4.1, not 4.3 for unemployment rate. Um, so the yield curve hasn't inverted again. Usually, you're looking for a yield curve inversion. It's gotten like 9 out of the 10 recessions. You need a yield curve inversion, and in fact, not just an inversion. You need it to uninvert for it to like start the clock for the recession. Um, you're looking for uh, a stock market performance of a bear market of like 20% decline from recent highs. Remember, the stock market is supposed to be forward looking. And so it should reflect the recessionary forces before it actually hits the main street. And
Mhm.
so we're not even, we're halfway to 20% drawdown on the stock market. We're looking for decline in industrial production that we haven't gotten either. Uh, we have a 0.5 month-over-month increase in December 2024, and the month before that was 0.9%. So a little bit of a slowdown, but not recessionary yet. Retail sales is on the fence because we're looking for consumer spending in order to keep up, anyways, the debt-based economy, and then a bunch of other things. Oil prices has gone down. Inflation seems to be if not stable, a little bit falling. Credit conditions is the only thing that I'm sort of, if I take a look at this for credit
Yeah, I
conditions,
know NFCI has been a big one that you followed for a little while.
absolutely. So
Hmm.
we have this tick up that's happening, or this uptick at the end over here. So this could be the start of basically the recession starts when you cross this zero line. but you're looking, and it's always like from the bottoms that you get these higher highs and higher lows.
Sure.
But if we're headed towards a recession, we're like starting that process. Sure, you might say, Tom, we might get some big catalyst that causes a recession all at once. Fine, but you can't really plan for that.
And I think that's the thing is I tend to be data driven. I'm sure you are as well. It's so easy to take headline news and extrapolate that into a narrative that makes you think that things are far worse than they actually are. A perfect example of this is the news headlines around how some of the big banks are starting to forecast an increased risk of a recession in the next year. JP Morgan is now estimating a 31% probability, up from 17% in November, and Goldman Sachs, their model is ticked up to 23%. But I think it's important to look at that number the other way around. What JP Morgan is basically saying is that there's a 69% chance that we're not going to see a probability of a recession. So just because the number has ticked up, to your point with the financial conditions index, we're still well below that zero line territory. It feels like early days here to be making any calls on a recession. What do you think?
Yeah, absolutely. There's only, if there's one thing I'd be concerned about,
Hmm.
it's this. So, well, two things specifically. One, I'll show the yield curve again here, because the yield curve went all wonky because of COVID. And so we have this weird situation. I'm going to pull up my trading view. This is an indicator I made at the bottom here. You're seeing yield curve for the 2 year.
Hmm.
The blue one is the one we're going to be talking about, which is the twos tens. And then you're seeing on the chart here, these red areas are where um, the Fed considers there to have been recessions.
Okay.
And then we're seeing on the chart over here. So just these blue markers over here match these blue markers for when the yield curve inverts. So if we take a look at historically, we'll see that we
So I
get
stand
yield
I
curve.
stand corrected on my earlier statement. I guess I had forgotten that the Fed actually did call that small period of time in 22 an actual recession. Then
Yeah, that's right.
okay.
They have a special word for that. I forget what it is specifically. Actually, let me pull it up because I want people to know.
And
Um,
maybe that's another reminder on this thing too. Even if we get to some magical zone where we've decided, okay, we're definitely in a recession, there's a couple of things to take away from that. And I will sort of jump on the bandwagon of these common phrases that we hear in the markets all the time. One is that we probably will find out we're in a recession after we're already about halfway through it. And the other factor to consider is that most recessions only last about 10 months on average.
that's right.
So the first thing to consider there is that because most of these indicators are lagging indicators, we don't get this data until the end of the quarter. Uh, that leaves so much time for us to kind of play a guessing game about what the data is actually going to tell us in the future.
That's right. So just what you mentioned over there, that mini recession for in 2022. This is what it was, this blip. So
Hmm.
compared to this one is COVID, this one is global financial crisis, this is a dot-com bubble. And so
Right.
even though it's a
Yeah.
recession, you
That
can
little
see
guy
the
down there, I wasn't worried about that little guy. I don't know about you,
that's right.
but we did really well since 22 if you were invested in the markets.
Well, what happened there, like if we take a look at the markets here, we see that we had this pullback, right? I think this was literally 20%. Yeah, 27%.
Hmm.
And if you literally bought all the way through here, you did better than anyone who was like waiting and got back in later on,
Right.
because we then went to all-time highs. But what I wanted to point out over here is, so we have yield curve inversion, and then about between a year and 2 years after the yield curve inverts for the twos tens, you get the recessionary period. Again over here, recessionary period. Again over here, recessionary period. Before COVID too, which is why I was short during COVID, because we had a recessionary signal. I was very happy about that, but I was not happy about this bounce afterwards. But that's a whole other story. This is what worries me. We got this yield curve inversion for the twos tens, right? And it
Okay.
happened after. So this happened so quickly. This drop happened so quickly that the GDP recession indicator, the yield curve took some time to come into play. So okay, fine. The speed of this is what mattered. But then we stayed. Oh, you're not going to see there. We stayed inverted for the longest time we've ever stayed inverted,
Right.
all the way up to about summer of last summer
Yeah.
of 2024.
Dur-
I have
during,
never
mind
seen it.
you, if you measure that bull market from the bottom during a hell of a run there from the bottom.
From here.
Hmm.
Yeah. Yeah, absolutely.
80% run up.
Right. So um, because I count a recession for the yield curve as the yield curve uninverting, there's a case to be made that we should not count this uninversion over here. That we should count this uninversion over here. In which case,
Hmm.
we've set the clock for uh, basically from this summer over the next year. Look for the recession, and I've seen a lot of people that I respect in the space, Ken Carson's, Darius Dales, the Mike Greens of the world,
Hmm.
who are saying that these sorts of things, that they are anticipating a recession in the as of the second half of 2025 or beginning of 2026, which I could definitely see happening. If that is the case, though, we should get first a rise to a new high and then
Hmm.
a rollover,
And yeah, I'd
because
want to see, and we've talked about this on the show as well in the past. The market's going to give us our earliest signal. We can't wait too long, unfortunately, for economic data to come through to tell us the real story or not. The market will know in advance. So we're going to be looking for some pretty big pullbacks in markets first.
that's right. I didn't get a chance to pull up the yield curve information for before 1988, but I wanted to just point out this period over here that I have been following, which is the inflationary period from the late 60s to late 70s,
Sure.
where on election years, stock market rose like 20%, but beyond that, we just had barely all time highs and then pullbacks and barely all time highs and pullbacks. So what is this? This is Nixon, Ford, Carter, Bush.
Hmm.
And so if we're be following that patterns, we have to make sure that as investors and traders that we don't get fooled by these types of drops. These types of drops
Not a big
happen
enough
all.
drop. Right. I'm with you.
Yeah, so we can't be fooled by that. You need to have the corresponding slowdowns inside of the economy, and even if you're worried about inflation over time, um, as long as you're smart enough in order to avoid these drawdowns, or even go short to take advantage of them, to place yourself accordingly, you could make money through this entire period. The people who don't make this money through this period are ironically the buy and holders, right? That's the problem, to buy and hold and not take a look at it. And
Right.
so this is one of the reasons why I care so much about markets, about markets education. Even if you're not like an active trader every day, knowledge of these systems gives you an edge, and you can end up past these troublesome periods better off than when you first started.
Yeah, I think it's fair to point out too that almost every recession that you had in that red zone there presented a hell of a buying opportunity for investors.
That's a
And
great point.
it's really important to realize that by the time the Fed or any of the Federal Reserves start to say that we're in a recession, we likely have already found the bottom in markets. And once you found the bottom in markets, that's the buying opportunity. Each one of these has one of those opportunities presented in it, where there's a big enough pullback where you can start buying undervalued companies or ones that some of the favorite brands that you've seen before, Tesla being an interesting example, maybe a little early for the game here, but some of these pullbacks, it's a good opportunity to DCA in my mind, slowly add to these positions as prices are coming down. I think Tom and we've talked about how quickly some of these reversals are taking place as well, and how they're
That's right.
accelerating in their pace. COVID being a perfect example of this, where that was probably one of the fastest and deepest pullbacks I've ever seen, that recovered and then accelerated faster than I've ever seen in the past as well. Those recoveries are pretty fascinating, because it just means that I would be watching the markets like a hawk during periods where we might be getting some initial data telling us we're in a recession, and the market is going to find a bottom right in the middle of that before we're even out of the recession.
You're absolutely right. That's a great point to make here, that the recession, people are burned by dot-com and mortgage crisis,
Correct.
GFC.
Yeah, yeah.
They think all market corrections are like big drops. This is what you're going to experience.
Hmm.
You have to understand that after the mortgage crisis, there was a complete 10-year change of the financial systems, to the point even that banks aren't even the main issuers of credit within or money within the global dollar system.
Right.
With Basel 1, 2, and 3, it literally changed over this period of time. So you'll see
Agreed.
here marked as Basel. Yeah, the Basel III started over here, and so we had Eurodollar 1, 2, and 3. And what happened is two things. One, the governments realized that they could do QE, right? QE wasn't a thing before the global financial crisis. They have QE to come in and ease financial conditions in order to mitigate downside risk. That's where the Fed put came into play. Then you have passive investment flows. I don't know how much you've taken a look into this, Mike, but this idea here that the as
401ks are buying automatically every 2 weeks.
exactly,
Yep.
that's right. And if they're buying it automatically, they're not forced sellers, right? In
That's right.
fact, they're not forced sellers until unemployment gets high enough. Not at 4.1%. They're
hmm
not forced sellers. And so if net, and I forget what it was, I think it's 2012 or 2013, something like that, where the amount of passive flows beat past active flows. And you get this thing where not only is the downside mitigated because they're not forced sellers, they don't even know what stocks they're buying. They're not even thinking about it. They're just buying the index. You have this effect where because they're buying the index, any stock that then gets added into the index, that's like when Tesla got to a high enough market cap and met the requirements, whatever got into the index,
Right.
then those passive investors are forced buying Tesla.
hmm
And so you get this reflexive loop to the upside. And then whenever there's this downside risk, the gamma, as people buy options for they're covered to the downside for the puts, and then they have calls. Those calls, as soon as you get a certain bounce, might go up 100%, 300%, 500% in value, and then you get this chase up, this chase up in asset prices, which is why we see this skyrocketing. Which is why I no longer look at stock charts or these types of stock charts with regular. I only look at it logarithmically. I don't know if you guys have ever noticed this on the channel. I don't look at
Oh,
it
you
this
have to.
way.
Yeah.
Yeah, because it seems crazy this way. But once you look at it logarithmically and you realize, oh, it's a rate of change here that we're dealing with, then it looks completely reasonable.
It's easier to see the patterns when you look at it logarithmically as well.
That's right. So I'm not really worried about recession now. It doesn't mean that we can't get new lows or anything like that. But the idea that you know we're gonna have a 10-year recession after .com, GFC, or whatever, I'm not worried about that yet. Talk to me again in 6 months, and we'll see.
Yeah, I like this comment here from TJ here in the notes, basically saying people are burned from '01 and '01 is now just a blip on the chart. Same with COVID. I completely agree with you across my entire investing career, especially right in college when '01 hit. Moving forward, it was a really long correction period. It took a long time to get back to break even on that part of the chart. But since then, our recoveries have been much more rapid. And I expect that because of the tool the Fed can now use, we will continue to see pretty rapid recoveries, even if there's sharp pullbacks in the market. So to that point, I agree. I think most of these corrections that we see in markets are going to be pretty short-lived blips on the chart. And thinking over long periods of time, 5 or 10 years or more, I think is the right way to think about your returns in the overall.
That's right. The last thing I wanted to mention there is that Scott Bessent, he does talk about. I just wanted to pull this up because I mean I gotta say this is my favorite Treasury Secretary I've ever seen. He's been so fun, so candid, and he's also like part robot clearly, and so it just feels like everything he says comes from this place of honesty. He doesn't know how to lie properly. Um, he's sometimes too honest. So I just wanted to play this one small part here where he's been interviewed on CNBC talking about recessionary signals.
Tax cuts. But just while we're on trade and the response from corporate America, when you say that when we're in a period of detox, you used that word on CNBC last week, is that a euphemism for recession?
Not at all. It doesn't have to be, because it'll depend on how quickly the baton gets handed off. Our goal is to have a smooth transition. But I tell you, Sarah, the easy thing for us to have done would have been to come in and just keep this massive spending level going. And it's unsustainable, but we have kept it going for a year, 2 years, maybe even 4. Maybe, but you're risking a financial calamity. So, we are trying to get this tax bill done. We are controlling expenses. And when we get the tax bill done, so if you can change the trajectory up revenues, up economic growth, hold expenses flat, or do the unthinkable and cut expenses, then that's a pretty good trajectory on growth. And if we go back to the model in the 90s,
All right. So, and then he goes on to say that if there was a company that you heard that was cutting drastically spending, cutting labor drastically, and trying to increase productivity, you would be buying that company hand over fist. And he goes, and that's what we're trying to do over here. So there's all
Sure.
kinds of complaints I have with how they're going about that and what the actual outcomes might be or what have you. But this type of talk is what I wanted to hear during the global financial crisis with the Ron Paul revolution, the whole thing. That's what I wanted. Fiscal conservatism, but without it bleeding over into the social sphere. Just get the spending under control and get productivity up. And and they understand that there's a period of adjustment for that, the detox that might be a downturn in the markets. But take that for what it is.
Well, as usual, volatility usually means opportunity. So I hope you guys are out there taking as many of those positive plays as you can.
That's right. All right, I gotta go buy Tesla. I gotta go buy Tesla now. All right, thank you guys. We'll be back next Friday with more After Hours.
Cheers, everyone.
Before we jump into our final segment, let's take a moment to shout out TradersPost, the automated trading platform designed to take the friction out of executing your strategies. Whether you're trading stocks, futures, or crypto, TradersPost connects seamlessly to your broker or exchange, giving you the flexibility to automate your trades without missing a beat. If you're tired of being the bottleneck in your own success, it's time to let automation do the heavy lifting. Head over to traderspost.io and see how easy it is to streamline your trading. TradersPost, because your strategy deserves to run at full speed.